Hi traders, welcome to this edition of Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just read through and set out some of the key objectives of this webinar. We look at, as I say, the key themes, narratives and stories really driving markets at the moment. These range actually from long-term fundamentals to short-term technicals and anything really in between, medium-term and further out as well. And these will increase in importance, increase or decrease in importance over time. At the moment, or during this webinar, we will look, as we normally do, and just look at markets generally, how they've started the week. And we'll also just then highlight a theme worth looking at. A lot of people talking about market troughs, stock market troughs, when they happen, and some of the features of those. Last week, if you remember, we talked about the Ukraine conflict, of course, but then also some specifics around inflation and some easing potential in price pressures. But that was probably a longer term theme, which we think is worth highlighting, similar to potentially the market troughs and what to look out for in stock markets, just as a sort of wider theme for everyone to bear in mind. If we're trading near term, of course, there are probably different drivers, but we sometimes think it's worth pointing out the wider narrative. Well then, as we normally do, review last week's key risk events, that one being solely really US CPI, of course. That shock, really hotter than expected report, set of data. We'll also look at gold and the technicals around gold at the moment after the breakdown last week as well, especially into Friday. Then we'll preview, so we'll look at, of course, this week's Fed meeting, the FOMC meeting, and a whole host of meetings. There are actually around 13 central bank meetings, I think, this week, and 8 within about 36 hours, I think, or so on Wednesday and Thursday. 8 major ones, that is. And the 4 key ones, or the 3 key ones for us, really, the Fed, obviously, Wednesday evening, UK time. Then we have the Bank of England the following day, and also the Bank of Japan, probably nestled in between those overnight on, well, first thing Thursday morning ahead of that Bank of England meeting, as I said. There's also the S&B meeting as well, so the Swiss National Bank, that is on Thursday as well. So a packed week, really, and probably we start with a review of the, well, we'll start with, how markets are looking at the moment. Generally, it's relatively quiet. We have mild risk-off sentiment, actually, mainly because, as we get this flurry, as I've said, of central bank meetings really ahead. As I said, rather a quiet day so far. Trading in Japan, I think, a holiday there, thin trading, and then obviously the UK has a bank holiday as well, but that is, of course, observing a day of mourning for the late Queen Elizabeth II. Of course, all eyes are on Wednesday's Fed meeting, with investors considering 75 basis point hike as a done deal, really, and then some pricing for an even larger hike, so 100 basis points, that is. But before then, really, yes, today, well, Asian stocks, small declines. The broad MSCI, I think, falling around 0.5% or so. Euro markets as well have slipped to start the week. This kind of downbeat performance, really, starting for today on Monday, really comes after last week's, well, the MSCI, the broad index of developed and emerging market stocks, that shed 4% last week, actually, its biggest fall since June. And really, there are these concerns about the health of the economy and, of course, the spectre, if you like, of further big rate rises from these major central banks, which have really spooked investors. There's no sense really that sentiment is due to turn around really for something better. So the big question really for this week is if we get anything slightly positive from central banks when their hiking cycles will peak maybe. Because these have obviously pushed out, especially in the case of the Fed, which we'll look at, and that terminal rate that everybody's now talking about. So not just a big rate hike coming, but obviously then the end rate of the peak in the Fed funds rates, the end rate in that rate going higher and higher. And we have a chart actually from an investment bank showing you just how that's moved and therefore how stocks have sold off, the reasons for that, and then obviously why treasury bond yields that is, have risen quite sharply. 2-year treasury yields now multi-year highs, of course. And I'm just looking at the 10-year US treasury yield, which is very widely watched, of course. A lot of markets price off that key gauge, and that's now hit 3.5% actually this morning. So that's given us this risk-off feel, if you like. Stocks are, well, futures, S&P futures, marginally in the green, but NASDAQ futures quite deeply in the red, it looks like, and also Dow futures as well. So that's given, European markets this sort of small move lower, as I said, and potentially, yes, that is putting people back, quite fearful, as we say. Interestingly, gas prices, we've mentioned these over the last few weeks, of course, big driver of the euro and markets in European, in the Eurozone. These have sort of generally tipped lower slightly over the course of today. In fact, and that's really markets anticipated this lower demand this winter due to the slowing economy, but also there are the better than feared actually gas stockpiles over these next few months, which obviously contrasts with potential cutoffs by Russia in some of the supplies. As I did say, we touch on firstly on just this bear market troughs really, and some of the common characteristics around stock markets. And obviously, if we're moving lower in stocks, then potentially, let me just pull up the S&P chart. That's the monthly actually, but that's the weekly there. Just showing that sort of breakdown from that trend line. Actually, I'll get into the technicals shortly, but just on bear market troughs, low valuations, of course, are necessary, though they're not a sufficient condition, if you like, for a market recovery. But we also need, or investors really start to price in a recovery when we reach, say, that peak in inflation, a peak in interest rates. And then, of course, bearish sentiment and negative positioning are also quite important. As I said, sentiment, there's no sense really that is turning lower, and there's no sense really that in some ways that we haven't reached that sort of peak bearish sentiments at the moment. So yes, those are conditions for the troughs. So again, this is probably a longer term idea to think about, but we're certainly probably not there yet. And that really suggests, as we've said consistently, markets really in for a bumpy ride. I think a couple of weeks ago we mentioned about the seasonal characteristics actually of the S&P, and we had this 4-week window of probably bumpiness. August and September were seasonally some of the worst months, or the worst months actually, in the 12-month period for stocks. And then sort of towards year end, we picked up slightly. That's sort of historically known, but for sure, most think we're really in for quite a bumpy ride. Of course, there was that period of optimism focused on the Fed pivot during the summer. That belief, of course, we were close to the peak in inflation, close to the peak in interest rates, but those conditions, we're not there yet. We've obviously had that big switch over Jackson Hole in late August, much more hawkish rhetoric from the Fed, also from some of the ECB speakers, of course. And since then, really, central banks, they've become a lot more hawkish. They're willing to hike rates, even if that means, of course, economic growth slows potentially. And then we have obviously fears of that growth turning into a recession and worse potentially in some areas of the world. It also means, of course, we get with some way to go to price in these higher terminal rates that we just talked about. So, yeah, markets potentially, we're going lower. We're sort of close to various actually strategies. Wall Street analysts really sort of talking about this sort of 30% from their peak as being a sort of level where then we get some of those conditions. So we're kind of close to that in Europe, for example. We're not too far away from that now, really. And it's true also across some of the emerging markets as well. But in the US, we do have further to go. US has high valuations, and of course, there's a greater probability of a sort of this softer economic landing in the US than in other markets. So technically, we always like to look at some of these major stock markets. So the S&P, you can see on this weekly chart, just ignoring these fib levels if you can for now, you can see that break lower of that sort of trend line, just a rough trend line really from the June lows. The June lows, remember, at 36.36, quite easy to remember then. And that's where most strategists now think we're heading. We've broken that trend line. We've also broken the August low at 39.03. So we're currently sort of 38.73 and a weaker close. In fact, interested to note that weekly candle there is a bearish engulfing candle. So you can see that the high to low range was bigger than the previous week's high to low range. And then we did also close lower and quite close to the lows last week. So a bearish engulfing candle there, which obviously points to more downside in prices. If we just go to the daily now, you can see again that trend line and that small break lower, and then the break, of course, on Friday below the September low at 38.86. Interesting, Friday we didn't close near the lows. Actually, you can see that candlestick there, the highs were at where 38.80 and we closed at 38.73. So we closed well off the lows, in fact, on Friday, but obviously on the weekly candle, it does look technically quite bearish. You notice I've got the fib levels there from the sort of June low up to the August high, and you can see probably I haven't got actually the 78.2, which I could just put in for you actually. So bear with me one sec. 78.6. If we stick that there, so that's where are we? Bear with me, around 3786 or so. So below is the next fib level, sort of minor fib level, really. 61.8 is much more important, and that's at 3900. So key level of resistance just above here in the short term, sort of, if we look at short term fib levels. And then below here, obviously, we're pointing towards, if we do move lower, then that mid-July low, 37.21, really is the key marker, the next key support, really. After then getting towards then the cycle June low, that's around 36.36. If we then just look at the NASDAQ, obviously that's been hit more severely, I'd say. Obviously growth stocks really getting a hammering, and you can see then the breakdown here below again, the September low at 11,928. This is NASDAQ 100, remember. Let me just take off the Keltner channels there. You can see the 50-day and the 100-day we pointed out before being as roughly resistance then, and then we've moved quite sharply lower over the last few days, held up a couple of times. But if we just go to the weekly again, quite like this chart, you can see the descending bear channel there, a small breakout, but we didn't manage to hold above it. And then the 200-week, the 100-week and the 50-week moving average very close together, around 13,700. They capped the upside there. and then we've fallen back into the descending bear channel. And you can see last week's, again, bearish engulfing candle, the range high to low, more than or bigger than last week's range, actually, on the upside and downside, and then we close lower as well. So potentially you can see the 200-week moving average offering support around that mid-June low at 11,037, the 200-week moving average at 11,134. And you can see there, yeah, if we do potentially go lower, I sort of initial support around probably 11,500 or so before we then potentially go to 11,000. Otherwise, we've got to move above probably 12,400, 500 to get sort of arrest this sort of downturn that we've had from that summer rally. If we just look at the Dow as well, which is here, sorry, yep. So the Dow, again, we did close off the lows on Friday, but we still closed below the last week sort of support level around 30,885. Then below here, we have that sort of initial support, the mid-July low at 30,143 potentially to aim for, before then that mid-June low at 29,653 potentially. That is in the Dow. We have highlighted, this is now the German DAX. We highlighted 12,400 being a real key level, really. The low in March was actually 12,438, and then the June low is around where 12,383. So sort of big level, just below 12,400. We're now moving down again towards that. You've got this initial support here, sort of starts of September lows around 12,600. Before then, really big levels around 12,400. If we go to the weekly, you can kind of see that here. Good to draw a line probably on there. So that was 12,382, which is worth doing as a key level, a key zone really around 12,400, we'd say. But then you can see then there's not much there till potentially the July low 12,200, and then we sort of get towards these November lows potentially if we do break this. So there's major support for the DAX around 12,400. We've highlighted that before, and we're approaching that level again. Okay, last week we think it's worth just running over the that main risk event, the US CPI data. If you remember, bear with me 1 second while I just pull up this. If you could bear with me, sorry. Right, just yeah, the US CPI data, of course. Major event risk, of course, we highlighted it last week in the preview. It's always worth reviewing this because it is critical for the outlook for the Fed, of course, this week's Fed, and generally going forward. We had a big market reaction to the data last week, so definitely worth highlighting. You've got a review of the main numbers here, 8.3% annually, of course, that headline figure, and 0.1% for the month, and that was against expectations of a 0.3% gain for the month. No, sorry, a drop actually in the monthly figure. And then August rise of 0.6% for the core was a real shock. And the annual figure 6.3% against 5.9% the previous reading, and a 6.1% estimate. But especially, yeah, that month-on-month headline figure reading, as I said, increased by 0.1, was meant to drop actually by 0.1%. But the core readings as well, are those increasing as well above estimates, and a real shock to markets, particularly as they'd really prepared for downside surprises. Everybody hoping and believing really that we'd seen a peak in inflation, and now of course that's completely really turned around. That sort of story, that narrative has turned on its head really, as we've got this move back higher in CPI, in core especially, and it's to do with, well, the gasoline prices obviously. The fall in gasoline prices didn't offset some of the rising price pressures elsewhere. So housing costs were strong, and we've highlighted that often. And rental components, they were up, I think, 0.7%. Utility payments were up 1.5%. And generally, really, it was the breadth and then the stickiness of inflation. So the stickiness being it's still elevated but staying there and not moving lower. And you can see this chart here. So this is the core CPI. So again, core excludes those volatile food and energy elements, components. And you can see that's kind of stuck around 5 to 6% on an annual basis. And when we've used the word entrenched, of course, when policymakers talk about inflation being entrenched potentially, then that is a key issue for them. And hence, we've had the market reaction that we've seen, and we'll touch upon that in due course. So that is one chart to bear in mind potentially. And then also we've got this range of measures, inflation underlying measures, which have all increased to fresh highs. These are various different measures that sort of analysts look at. We don't want to get too technical here, but really you can just see the general direction where we had slowed up, say, in ex-food and fuel. So the red line, the core line, and then we've moved up again, of course, dipping below 6%. Then we're back up above 6%, 6.3% in that core. And then these other measures of inflation, stripping out various elements, stripping out, say, the outliers on the upside and downside, those being trim mean really, and then looking at the real core elements. And again, all these sort of charts, all the lines, of course, are pointing northwards. Really a shock to markets and dashing hopes really that we might have seen a peak in inflation, or at least a slow decline in price pressures. Really telling then these few charts, and you can see also if we just look at, well, if we just go to contents, again, don't want to get too caught up in this, but you can see shelter is always a third pretty much of CPI. So where shelter goes, obviously, and there's quite a lag. We've said before about this lag in shelter costs, and any fall in that is going to take some time to get through the system if there is a fall, a noticeable fall, that is. And it takes up around, one third of CPI. So that's why we do concentrate on these sort of areas of some of this data, just to educate you everyone, and really to educate myself as well and the team here of just how important these elements are to the wider figures. If we just go back a touch, a couple of sort of analysts have touched on this sort of diverging part, sort of trying to cling to some hope really, the difference between core CPI and also core PCE. Just again, don't want to get too technical, but the PCE, that's really what the Fed uses as its primary inflation gauge, and it really, because it's a broader measure of inflation pressures. So PCE index, really, that's based on survey data from consumers. The CPI. Let's start again. The PCE is really based on a wider measures of inflation pressures, and it's based off surveys from households, but also surveys from businesses as well. Whereas obviously CPI is consumer price index data, so that's based on what consumers say their buying and kind of their out-of-pocket expenditure, if you like. But the Fed uses the core PCE, and just this chart, I think we're sort of clinging to some hope, as I've said, that the PCE, the measure the Fed uses, or their preferred measure of inflation, is sort of ticking down. But we have seen this obviously in the CPI number. So yeah, we're just, as I said, clinging to a bit of hope potentially. All in all then, well, what happened near term, the market reaction was pretty telling. And the recent hawkish rhetoric, of course, around a lot of the Fed members was still fresh in the market's minds. And we had this abrupt turn really from positioning where virtually everyone thought we would see lower prices below sort of 8%, 7.9% for the headline. And that meant a strong bid in the dollar aggressively after the release. And we saw bonds and equities in a pretty sharp sell-off, really equally sort of volatile fashion. I think just to take note of that selling even, we did get, as I said, we got quite sharp downturn in stocks. You can see on the daily, it was the 13th, we got that big sell-off, so we moved below the 50-day and 100-day moving average. Really big sell-off, as I said. Biggest daily loss actually, I think, since September 2020. Really sort of frenzied selling. It did hit nearly every US financial market really at one point during the session, actually, after the CPI data. I think nearly 2,000 stocks on the NYSE actually fell in value in tandem. And that's normally really only seen real severe, levels, really severe periods of market stress. As for the NASDAQ, obviously that got hit even, probably the worst index actually, full of growth stocks. And we know that growth stocks really do not enjoy higher rates, of course. And yeah, I think not one of the NASDAQ's 102 members closed in the green on the day. And that's the first time that occurred since the pandemic crash, actually, around 2 years ago. For tech stocks, yeah, just to reiterate that point, of course, higher interest rates, which is what happened after the CPI, and with 2-year yields obviously going above 3.75% for the first time since 2007, and then obviously the 10-year US Treasury, that moving up towards the 3.5 marker. And then also this terminal rate, which we'll talk about later as well, that moving above 4%. Just to recap, as I said, tech stocks, really the impact of higher interest rates can hurt technology companies with high valuations, because those are based on future profits. And really these higher rates, they mean that earnings years from now are obviously worth less today. So yeah, NASDAQ got hit severely, stocks in general as well. And all in all, then the report, the CPI report, really implies, as I said, in a way, it's sort of a higher destination point for the policy rates, for interest rates, and signals really increased conviction in the need to keep rates up there higher for longer, so for some time. And really once that destination, wherever it is, the peak in rates is reached, then holding that rate actually at what the Fed perceives to be kind of restrictive for a long time really seems to be the strategy to bring inflation back down to target. Remember, the target for the Fed is 2%. So yes, this terminal rate that moved up into the 4.25 range from 3.75 to 4% range before the release, and that, yeah, essentially the red hot data really increases fears around the Fed needing to slow demand even further to bring inflation back. Interesting, some people are referring back to sort of the 80s. It's a long time ago now, but that cycle where, if you read about it, well, Paul Volcker was the head at the time of the Fed, and he really, to put inflation sort of back in the bottle, He took rates to 15%. And was prepared to accept recession as sort of collateral damage, if you like. Of course, we must stress no one in the market thinks the Fed funds policy is going above 10% anytime soon, of course, but the inflation release, of course, did see the terminal rate move above 4%, as I've said, and then, there's much talk now of potentially it going to 5%, dependent on the FOMC meeting this week. If we look, I said we look at gold because obviously that had a big move last week. It broke down, dipping 2-year lows really on Friday, actually, and that was obviously due to the higher dollar, which was driven then by that sharp move in US Treasury yields on expectations of the rate rises. So the key downside level in gold is the August 2021 spike low at 1677, and that was reinforced actually by the pandemic low. We've got it here, the dotted line there. Pandemic bottom at 1676, and then you also got the July low at 1680. So really a zone of support that we did have, and you can just see then on this weekly chart that break lower. The low was down to 1654. That's 19% below its peak in March. That peak there, spike real higher at 2070. So we're sort of 19% off that now, and I think we're around 8% lower on the year now in gold. So quite interesting that really gold, it's obviously traditionally viewed as a hedge against long-term inflation, but that's obviously not been the case this year. And really gold is tracking real yields. So real yields, what are they? Those are the yields adjusted for inflation. So projected inflation minus the nominal yield, that gives us a real yield, and that's now above 1%, quite a psychological critical level there. We've been in negative territory in real yields since sort of March 2020 up until April this year. But now we're just hovering around just above the 1% level, a key psychological level, as I say. And really then you've got to remember higher rates for gold, it really makes, or higher rates make non-interest bearing assets like gold less appealing, of course, because they in effect raise the opportunity cost of holding that non-yielding bullion. So technically, yeah, we can see that break lower, the break potentially below this key support level. That's the 200-week moving average, actually the black line there at 1676 as well. So huge support slash resistance then potentially if we do now move lower. Initially, we have 1654 as a level, but potentially then we have to go back to, well, I'm just looking now, really. We just probably have to go back to support around 1661, 1670, which is where we are now, and then probably not down. The next major support probably around 1600, 1609, 1611, I think I had. So, yeah, still, as we said in the dailies, if you follow our dailies, we probably write about gold at least once a week. On Friday, I think we did, and then the previous Friday, we said it was still stuck in this descending bear channel. Pretty pronounced now, and we're back sort of, and we can move quite substantially lower potentially if we go to the bottom of that channel. That will be below 1600. This is obviously all eyes will obviously be on the Fed, of course, and the Fed meeting this week, this Wednesday. Pivotal meeting. If we just then go to the CME Fed Watch tool. This obviously for those of you who haven't followed this, CME Group, Fed Watch tool, Fed Funds Futures pricing for each FOMC meeting. So obviously this one this week on the 21st, Wednesday, and then we have 2 more left this year in November and then mid-December, and then nothing till the 1st of February. So 6 weeks or so before the next Fed meeting. Really interesting juncture we're at, of course, for the Fed. Key question, firstly, is probably how big will the Fed go? Of course, if you read our week ahead We're speculating in there whether we go 75 basis points, which has, you can see, an 85% chance, taking rates to sort of that range of 3 to 3.25% from 2.25 to 2.5. Obviously, after the US CPI data, we, if you remember, there's around, I think, 80 to 90% chance of the 75 basis point hike, but then the 20% or so was fixated on a half point rate hike. Obviously, since the CPI report, we've switched that now, and people are talking about 100 basis points in one meeting, and we're now in a 1 in 5 chance of that happening. Really interesting then. So still sort of non-negligible chance, I'd say. You will know we sort of figure that above 70% chance, the Fed really don't like to upset markets. I know there is some focus on the Wall Street journalist who revealed the larger than expected 75 basis point hike in June, because obviously we're in a blackout period for the Fed. And if they did want to go by 100, then you would think they'd really try and line that up, probably this morning, actually, with a journalist in the know who really gets the nod and then puts it out there that 100 basis points is what the Fed are keen on. I think so far that journalist has said we're at least going to get 75. But unless we get a specific signal from him, I think, we think it's probably unlikely. The 1% risk, as I said, so it's not non-negligible, if you like, 1 in 5 chance. We've said inflation expectations are looking slightly less threatening actually now, and the growth outlook, of course, is slightly more uncertain with concerns around the housing market, of course. Mortgage rates up above 6% now from sort of 3% or so, I think around a year ago. Clearly a 1% move would be, a massive signal from the Fed, really their intention, really revealing their intention by front loading. But you kind of think that would denote really some panic, and really that the Fed weren't in control, which sort of lends itself more to the 75 basis point hike. That would obviously follow on from their previous hikes of that size. So firstly, the question, how big they go at this meeting, 75 basis points most likely. And secondly, we then get the updated dot plots. So this is where Fed officials offer their individual projections for where they see interest rates, where they see inflation, unemployment, and GDP over the course of the next few years. And we have to remember, of course, these were last released actually in June. So it's been some time since those previous dot plot that we've seen. The current median forecast for interest rates was 3.4% by year end, this year end, and 3.8% by the end of next year. And now, futures markets, they expect rates to be 4.2% by year end, peaking in March next year at 4.5%, and then potentially be cut by or cut to 4% by the end of next year. That's just market pricing. That's aggressive. We've seen that aggressive move recently, but whether we get that in these dot plots or some officials moving the median higher, certainly we're expecting inflation forecast to be lifted for this year, with any change, if any, for next year, which is currently for inflation expectations at 2.7% for next year. So if we do get that moving, then that's obviously a sign of the thinking at the FOMC. Regarding the GDP forecast in June, that was projected at 1.7% for both this year actually and next year. But there's obviously expectations of a slowdown for this year, and forecast potentially cutting this year in half actually. And again, if we get lower revisions for next year, of course, markets will be watching that. Unemployment, I think those rates were forecast at 3.7% this year, 3.9% next year. So it's just as well part of the dot plot, part of the projections by Fed members to focus on. Then finally, thirdly, there will probably be obviously questions in the press conference, potentially around QT, so that's quantitative tightening, and really how long policy is expected to be restrictive for. Any hints on that would be really seriously market moving, especially as the program's now sort of ramped up to 95 billion a month. That's in quantitative tightening. And then any views possibly on these persistently high inflation figures, which obviously then will impact potentially rate expectations further out. I think consensus for flows decisions really, so the 75 basis point in September, and then now there's probably a 50 basis point increase in November and December. We can look actually and see if we go to 3 to 3.25%, then November, yep, 62% chance of a 75 basis point hike there, and then sort of 50-50 bet on another 75 basis point hike in December. So really instructive of what might happen. Market reaction, 75 basis points then is the minimum really, isn't it? And it's seen as really sort of data dependent meeting by meeting approach, you like. So anything less is of course really dovish, and we'd see the dollar really sell off sharply because it would denote that sort of earlier end to tightening with a lower terminal rate. Remember that terminal rate is around 4.5% now. If the dots modestly undershoot market pricing, then again we see downside bias to the dollar and a relief rally for stocks. Yeah, so really 75 basis points the bare minimum. That's the base case of most. Inflation revised up, and then, well, a reaction if we got 100 basis points, obviously that would be hawkish. So you'd see a knee-jerk stronger dollar. Higher terminal rate, of course, as inflation forecast will probably be revised a lot higher. And then potentially you see that terminal rate going towards the 5% level. What we've seen with outsized jumbo sort of sized rate hike is that then the next meeting gets to price in a similar type move. If, of course, US price data, if that stays sticky or Powell sort of hints at that being a worry, then, of course, markets would be second guessing the meaning of kind of restrictive as well. We should say positioning wise in the market, so CFTC data, that is futures data really, in the Commitment of Traders report released every Friday, that measures the net long and short positions, if you don't know. So CFTC data measures the net long and short positions taken by speculative traders and commercial traders. So it's a great resource for sort of gauging how heavily these market players are positioned. It clearly shows market long in dollars, 5 straight weeks now of net buying. I think the dollar position now is the most stretched since July 2020. So let's just look at, shall we, the dollar. We haven't quite seen the dollar actually, which we should do before this, which is here. Bear with me 1 second. Obviously, we're very close to cycle highs. Last week's move sort of took us back above that previous high, the mid-July high at 109.29. You can see a nice push above that. Again, we were hovering around there. Did dip below, as you can see, last week towards the 50-day moving average of 107.75. That is now, but then that big strong move on the US CPI data. Now looks like bullish consolidation, doesn't it? Above this support level again, that acts as support now. And potentially then we're moving up towards the 110.78 level. This is the DXY. And for euro dollar, you sort of flip that DXY chart on its head, don't you? If you remember, DXY, 56% or so of that index is made up of the euro. So flip that on its head and you can see the 50-day moving average acting as resistance. That's now just below 101. Really And we're sort of hovering then again above the mid-July support there at 99.52. You could probably say the euro has sort of done better, slightly better than some of its other G10 peers. Short-term charts really reflecting a sort of demand on dips, if you like, around this sort of 90.50 level, 1950s, 1960 zone or so. But we're still kind of struggling to advance. So as I say, it's probably bearish consolidation, just like it's bullish consolidation in the DXY. Yeah, that failure around 102, sort of not good. That long-term trend line holding prices as we highlighted. So really risks are probably tilted to the downside here. Intraday gains capped around sort of 10010-10-15 or so, and then if we do get this loss of support, which is pretty big, 99.50 area, then potentially we drop down to the recent low, that cycle low 98.63, and then we probably have to go some way back really to getting the next levels around yes, that sort of 95 level potentially, but big support, and obviously a big meeting coming up. Just briefly, we should touch on the other meetings. Sorry, we're taking some time here, but we've got obviously the Bank of England meeting. Surprises in UK data last week. They were kind of two-sided actually. So we had labour market pressures remaining intense. Evidence that wage growth has continued to accelerate. But then we had the sort of absence, fortunately, of that sort of upside surprise, if you like, in UK inflation. It dropped below double digits, and obviously with the government measures potentially taking around 4 to 5% off peak inflation, which was possibly up to sort of 15-16%, then inflation then sort of hovers around this 10% mark or so. 9.9 was the print. We hover around there going forward for the next few months at least. As I said, so headline inflation, that did drop a touch lower below consensus on the sort of 7% drop in petrol. But then core inflation, again, policymakers focus on that probably more so, and that's sort of really, because it put it more accurately, it's the more persistent parts of the inflation basket, if you like. And the news again was quite mixed on a month-on-month basis. The increases in August kind of seem fairly broad-based, but there are signs that some of the core goods inflation is easing off. So third quarter GDP, sort of that looks more likely to show a contraction now. And it seems that the broad implications for looser fiscal policy, together with tight labour market, I've said, and the wage growth as well, which the hawks will worry about, really means that the MPC are in tightening mode for some time still, and that argument will be strengthened by the mini emergency budget by the UK government on Friday of this week. So more sort of fiscal giveaways, if you like. All that means, as I said, MPC in tightening mode. Probably the pendulum hasn't quite swung to a 75 basis point hike on Thursday by the Bank of England, similar to the ECB and the Fed. Pretty close call, really, but markets sort of torn as well. I think about 66 basis points priced in for this meeting, so not the half point in midway, really, between the half point and a 75 basis point hike. 50 probably most analysts are going for. I think that's consensus amongst analysts, so not the market, slightly different analysts, of course. That would be a similar size move to August, of course, and then potentially another move is priced for 50 basis points in November. Remember, the MPC has raised rates at 6 now of its last, 6 straight meetings now. Rates are expected to go from sort of 1.7% to 3% at least by year end. It hasn't really helped, of course, sterling sort of racked by these fiscal measures, potentially investors taking money out of sterling assets potentially, and real uncertainty over what the government is doing and how they're going to pay for a lot of these fiscal giveaways, which will be announced on Friday. Maybe not the detail though, again, which just sort of again points to uncertainty over sterling. You can see for cable last week, yeah, we broke the pandemic low at 114.09, that dotted line. And if you look actually on the weekly, you can see this bearish engulfing candle, quite significant again, really points to lower prices really. Bearish engulfing, that's on the weekly candle there. So the range, the total range, much wider than the previous week's range, and closing, well, we actually closed where 114.16, so just above that pandemic March 2020 spike low at 114.09, but then we are moving lower now into, where are we now, 113.80 or so. Last week's low was actually 113.50, but you see really any sort of rallies, any counter trend rallies don't look really likely, and kind of minor rallies actually are unlikely to be sustained. Should probably look at Euro sterling briefly. That's hit the highs. You can see that bullish consolidation there. I think we called that last week. And then if we could break the 87.21 high, 87.22 actually, September high, which we did, 3 really solid days actually, a strong move higher. And now we're sort of above that 200-week moving average, 86.98 there. We're potentially then looking at probably these lows from 2020 at around 88.75, or a bit lower, 88.61 and above really, as a target for bulls. That's in euro sterling. Very briefly on dollar yen, we do have the Bank of Japan meeting. They're expected to maintain their ultra loose monetary policy, really as market participants really focus on whether authorities will mention the yen's descent, obviously, to new 24 lows that we hit last week, and whether authorities will directly intervene. It really was a tense week last week, really. Everybody getting excited by Bank of Japan officials phoning around currency trading desks, inquiring about market conditions in the so-called rate check. We wrote about that in the daily, actually. Everybody getting excited that but potentially that's the final signal before intervention. But really it illustrates the sort of government's, the authorities' sense of alarm about the yen's sharp fall against the dollar, especially. And certainly in the past, those checks have preceded intervention by the Ministry of Finance to control the exchange rate. So Bank of Japan, does that affect the currency? Probably it doesn't really at all. Governor Kuroda really has repeatedly argued that the bank needs to maintain its stance until wages and inflation rise in a stable and consistent manner. So really, most analysts, they expect Kuroda to stay the course until his term expires next year in April. And this is still the driver, of course, of dollar yen, but really 145 looks like a potential line in the sand, but we can't really break down until, say, the BOJ changes its course potentially, which contrasts, of course, with a quite aggressive Fed and the FOMC. Support just in dollar yen 141.50, we'd say, and then obviously this line in the sand at 145. Okay, I think we should probably wrap it up there. We've been going on long enough. I did mention this chart, actually, apologies for this, just showing this this big move in rates in US interest rates, really, and this change from 2 weeks ago, the black line 2 weeks ago, and then just this move above 4%. This is why we're getting the move lower in stocks, and obviously then the dollar sort of jumping up above that support level. But noticeably, actually, is interesting. Obviously, now we're going to be waiting for the Fed, whether we can actually make new highs or not. Okay, follow us on social media, all these different channels. Good luck with trading out there this week, of course, and stay safe. Keep your position sizes. Yeah, just take care of your position sizes, I would say, because especially around Wednesday and Thursday, we do get potential for huge volatility. Okay, all the best, and we'll hopefully speak to you next time, next Monday.